But when there's a market correction, we saw Bitcoin fell because a lot of people were buying Bitcoin on margin. And when the market fell, the margin got pulled out. They had to force sell these risk assets.
Hello, everyone. My name is Chris Yang, Regional Business Consultant here at Curve Investment Management, and welcome to our 10th episode of Curve Your Enthusiasm. It's honestly hard to believe. We're already at double digits, and it's been such a huge milestone for us. So whether you're tuning in for the first time or you've been with us since day one, we just want to say thank you for following along on this journey. And today, I am thrilled to be joined by our CEO and founder, Howard Chan, and our lead portfolio manager, Dominic Turson. Now, before we get started, just a quick but important reminder, the trades and strategies we discuss on this show are not meant to be taken as financial advice. And as always, please consult your advisor before making any investment decisions. And just to set the scene, we're recording this on October 9th, 2025 at 5:14 p.m. Eastern Time. Now, Howard, I know you've been traveling nonstop lately, and you've been kind of all over the place. So, where are you based out of today?
Thanks, Chris. I'm currently in Nashville, my first time in Nashville, and it's a great city to explore. Maybe one thing that's very topical was I left really early from the house yesterday, anticipating a long wait in the airport because of the government shutdown. I was expecting lines around the airport. When I got to the airport, nobody was there. People were front running. I got through security in like 3 minutes, and then when I was landed here in Nashville, it was also pretty quick. So, thank you, government shutdown, I guess.
There you go. And Dom, I know it's almost midnight for you in Paris, so thank you for hanging in with us. How's life over there in the City of Light?
Yeah, City of Light. It's a bit gloomy, to be honest, with the beginning of the fall. But on the upside, a bit like the shutdown, we don't have any government yet in France. Now for 2 months.
Who's going to be your new prime minister? This is what the 5th, 6th, 7th, 8th, 9th?
Yeah. Does it matter?
All right, awesome. Well, thank you both for sharing that. Well, so let's just dive in. There's a couple of topics that I do want to highlight, but one in particular, you could probably take a guess, is a topic that has been all over the news and social media. Gold just broke all-time highs, crossing $4,000 an ounce, and silver just hit $50 an ounce, the first time in history. Central banks keep buying, ETF inflows are up, and safe haven demand hasn't been this strong in years. So, Howard, what's really driving these moves right now?
Yeah, Chris. So I think it has a lot to do with, the government shutdown. In essence, I think a lot of the developed countries, the governments really are not working, and people have less faith in the governments as well as the currency that they issue to preserve value for their investments, their savings. As we've talked about on this podcast, we've seen the financial positions for a lot of these developed countries continue to deteriorate. We know in the US, we now have close to more than $2 trillion of deficit. And there's really no sight, in the near future to really correct that. We've seen the same thing in France. In fact, it's gotten even worse after COVID. We've seen this in Germany, where they're, for the first time, really issuing more debt to fund the defense industry. I mean, Germans in particular, they're really, really concerned about inflations, right? And they're also issuing more debt to fund spending. And we've seen actually Japanese yield reach all-time highs since we last talked. So I think the higher yield is an indication that the market is less and less confident that a lot of these developed countries can continue doing what they're doing. If they don't have a good balanced balance sheet, there's less and less faith in fiat currencies being able to retain their value. To me, is the primary driver of why people are looking for alternative sources of assets to preserve their value. You could see it in, gold that has reached all-time highs, and then a substitute for gold being very expensive now, is silver, and that has also driven prices. But that's not just the concern is not just on the ordinary people's level, population level. It's also on the institutional central bank level, as you mentioned, right? A lot of central banks have been holding dollar assets in the form of treasuries or other US dollars as a means to keep stability in their own currencies, or just being able to be pegged into the US dollar to borrow that stability. But given the worsening situation with the US, they have to diversify out of dollars, and a lot of them have been buying gold as the alternative. And so that's why we see both retail and institutional forces buying up, these precious metal assets.
And Dom, I mean, we at Curve here, we manage a couple of gold and silver strategies. How do we run it? Maybe could you give a little bit of insight on that?
Yeah, sure. So usually gold and silver, they don't pay an income, right? That's just metals somewhere in a safe, and not like a deposit at the bank. They don't pay anything. So there is a way to have income from those type of assets, and it's by using options. So we can combine the growth that they can offer. As the word explained, there will still be the demand for it as a safe haven from central bank or diversification purpose. So you can still get the growth on the upside from those assets while getting income, and that's through options. So now you have to be careful because when you sell an option on those metals, it's not like equities. Equities usually you get paid for the risk you take when you sell volatility or options. On metal, it's less clear. So you have to manage it on both sides, not only on the upside, but also on the downside. And that's how we do options.
And Howard, in the near future, where do you see the price of maybe gold or silver in the near term?
I gave a reason why gold and silver is rising from a long-term basis. We don't see a lot of these developed governments really correcting their finances in the short term. It's a very politically hard thing to do. You either cut social benefits or you raise taxes to increase revenue, which is not popular. And right now we really see around the developed world, really no government is willing to do that. But there are actually a bit of a short-term reason why gold and silver has also increased in price. So particularly this Wednesday, we saw the Fed release minutes that said that the market was already pricing in 2, maybe 3 more rate cuts until the end of the year. And so typically, when you have a rate cut, that means that your currency is less competitive than other currencies, and so there's a sort of a dollar debasement essentially. And so if you own dollar assets, you want to then also have an alternative. That's a short-term reason. So today, Thursday, the market just ended. We saw some retrenchment of gold. It fell back a little bit, but we don't think this is a short-term issue. You have short-term forces and long-term forces that both to us indicates that the gold is going to continue to be higher. And when gold gets too expensive, then you see a bit of a second leg in silver because, believe it or not, we were on the gold standard, but before that, most countries were actually on the silver standard. So there is precedent in which silver also preserves value. So we see both of these to continue to really increase in price because of there's no other alternative to keep your savings.
Yeah, and I was looking at a stat a few days ago on silver. 30% of the industrial demand from silver, which is a lot. Silver is mostly industrial, was from solar panels. Here we go. More solar panels, more silver.
Yeah, and I think that's probably worth to mention, like, what's the difference between gold and silver, right? I mean, gold primarily is an asset in which people see as an inflation hedge, a portfolio hedge. But as Dom mentioned, silver does have industrial uses. It's used in circuitries, even in your teeth, silver fillings, etc. So there is an extra form of a demand for that particular metal. So again, as we kind of go through to the AI age, right, we're going to see even more demand for silver and these precious conductive precious metals.
And actually, that brings up another fascinating point, that's actually also been in the headlines, is that crypto and gold are rallying at the same time, like you said, right in the middle of a government shutdown. Bitcoin just surged above $126,000 on and on Monday alone, Bitcoin ETFs actually hauled in nearly $1.2 billion. And meanwhile, gold ETFs captured, I think, around $9 billion of fresh inflows in September alone. So this isn't just price action, it's massive investor flows into alternatives. It's signaling people want stores of value outside of traditional bonds and equity. So, Howard, how do you read this type of trend, and what do you make of this with all the headlines?
Yeah, I mean, I will say in the beginning I was not a true believer in Bitcoin, right? And we saw in the past cycle where um, people equated Bitcoin as digital gold, but when there's a market correction, we saw Bitcoin fell because a lot of people were buying Bitcoin on margin, and when the market fell, the margin got pulled out. They had to force sell these risk assets, and we saw actually Bitcoin behave more like equity before. But I would say in the last 2-3 years, not only has retail adoption in Bitcoin, there's actually a lot of more and more adoption from institutions. So it's become definitely less volatile than it was 15 years ago. And I do think the premise that Bitcoin originally being a decentralized currency that no one country owns the network, right, does make it, if you're trying to find alternatives away from fiat currencies, right, it is believable that that could potentially be a store of value. So it's not, I think, I think it wasn't necessarily digital gold before, but as more and more people hold it, as volatilities fall lower and lower, and that people believe that it is an alternative, it will become more like digital gold. I mean, there's no intrinsic reason why gold would preserve value. It only preserves value because everybody else believes it preserves value, right? So, we have, whatever, since Egyptian times, people have used gold as jewelry, and people have passed the jewelries from parents to child, right? So it's been a long tradition in human culture that we believe gold preserves value. And I think as more and more people adopt Bitcoin and see that as a way in which you can have a digital version of gold, it will reinforce itself and become a digital version of gold.
Dom, do you think investors are lumping crypto and metals together as hedges, even though that they're pretty different?
With the move of gold being the safe assets, no matter what, more recently with the problem on the debt issues, Bitcoin, as Howard said, with a digital gold, could replace that. I remember, with the financial crisis of 0809, that's when Bitcoin was created, right? And in a way, it's a way to avoid confiscations, either being confiscation of via deeply negative real rates. When you have deeply negative real rates, well, it's tough to get revenues from what you have. So you go in safe assets that store their value. So you have that, and you have after you had the I remember you had the European crisis where the state can actually confiscate your deposits. Hello, Cyprus. So this Bitcoin, little by little, people realize that it's a way to store assets away from those risks. And as Howard said, on the trading side, it's still more volatile than gold. It's still less deep trading-wise in volumes every day than gold. I guess if you want to do large amounts, that's going to take time to get in and to get out. But Yeah, with time, it will probably arrive. And I guess on the hedges, away from the confiscations, the true test will come when we will have a fall in the equity markets. When
For
equity
sure.
markets will fall, gold in general goes up. Will Bitcoin go up?
I guess we'll just have to wait and see. But yeah, so I guess at the end of the day, the theme is clear. Investors want alternatives beyond something like traditional bonds. The next thing I want to talk about is as we roll into Q4 of 2025, and I know we've talked a little bit about this in our last episode, but what's your outlook for the markets with just everything going on, Howard?
Well, I think last time we talked about this, we were starting to be a little bit more defensively positioned in equity space. We do like the AI infrastructure story, but we've also barbelled our portfolios to be more consumer tech, things like Uber, Netflix, and Spotify. I will say so far, as an investment manager, you're either early or you're wrong. We're a bit early, largely because as I think as the market expects to have a lower rate path going into 2024, that has been actually lower discount rate has actually boosted asset prices since we last chatted. So the market has actually gone up. But we continue to, at least for now, really hold outlook that we've already seen a lot of economic indicators show that the economy is slowing down in the labor force, in sentiments in PMI surveys. And at the same time, inflation is still elevated. Whether you think tariff is a one-time thing or not, it's still above the Fed target, right? So right now, the market is a little bit on a rate cut high, but hasn't really reflected necessarily upon why the rate cuts is happening. Is economic slowdown, and has yet to adjust for that. We saw a little bit of that today. There's some retrenchment in the market. So that's our macro outlook. But in terms of the various different markets, actually, it kind of be good to if we go through each one of the markets and how we would position them, right? So I mentioned our equity. We still think, in the last earnings cycles, most of the earnings came from the biggest companies, obviously because of their capital expenditures. That will continue to go on, although it's starting to flash a little bit of yellow. There's a lot of circular capital expenditures amongst the different companies that we're now a little bit more wary about. We like the more consumer-focused staples, so that's a little bit more defensive. And obviously we like gold because in an environment in which you have lower rates, this sort of competitive debasement is among developed currencies. Gold does provide an inflation hedge and risk hedge in a portfolio. But actually, Dom, maybe you should speak about if we were back in our former firm, how would we look at the yield curve? Where would we expect fixed income to be in this environment going into the fourth quarter of 2025?
Yeah, fourth quarter. Right now, the expectation is for the Fed to cut rates at each meetings. This year, the Fed funds to go at around 2.93% at the end of next year. So about 1% cut in 1 year. To me, that sounds plausible. If inflation is around 3%, 2.8, 2.9. So it is the level of inflation. That means real rate of 0. So that's kind of neutral, to be honest, for the economy. So the Fed is balancing low labor markets right now, although we don't really know because we don't have data yet, but that with the high inflation, so I would think that 2.9 is probably fair for next year, so on the short term. On the longer dated bond, that's tougher. Their nominal rates decreased recently. I think this year they decreased. I'm not sure I would still buy them. Probably waiting for a pullback up in yields to go in them because there's still the problem of high deficits, the problem of currency debasement, and states or central banks moving away from treasuries. So that's the risk on that one. But on the front end, I think it's pretty fair.
Yeah, and I think in this environment where we have lower rates, for the advisors we work with, actually, income generation will be increasingly difficult, right? So if the base rate is going down, traditional assets like fixed income yield would generally fall unless the spread, widens out, which, could happen, I guess, if there's increased risk in the corporate sectors or other, non-treasury assets. So, really, I think investors should reevaluate in their portfolios if they have clients or individuals who have a certain income target. They need to reevaluate what's in their portfolio, look at, traditional sources, whether that will give you the income that you need for your target. If not, then maybe explore alternative forms of income to meet that need in the lower rate environment.
Now, Howard, as I'm in the field, this is a question that comes up pretty often from advisors. So clients want growth, but they also can't really stomach big drawdowns. So how do you think about staying invested in growth while still managing risk?
Yeah, I mean, that's always hard, right? The one thing I would not do is, sell out of your allocation completely and then reinvest when you think the market is, risk on again. I think timing is always extremely, extremely hard. So you probably would want to err on the side of being invested than to sell out of it, right? So if the case is that you're invested in your exposure, your equities, etc., the way we do it to mitigate or manage risk in our portfolios to use options to modify the risk exposures that we have. So again, as we mentioned in our strategies, we prefer names in AI infrastructure as well as consumer tech, but we can actually decrease the exposure in the portfolio by putting some option overlays that will decrease our sensitivity and also mitigate downside if there's a market sell-off. So one thing we do, if you write cover calls, that actually decreases the sensitivity to the underlying. If your outlook is that we reach a local high in the market, that there's not another runaway for markets, selling calls can give you income and as well as decrease sensitivity to the underlying. So if there is a sell-off, you fall less. And then there are cases in which we outright buy protective puts. So we can still be in the name, but if it falls, we will be able to, the puts will have gains that will offset the unrealized losses on the stock. So it will mitigate downside. So those are two ways in which we are being a bit more defensive in the portfolio.
For sure. So it's not about growth versus income. It's really about kind of blending both. Next, let's talk about something that's been brought up a lot in the world of high yield ETFs, NAV erosion. Howard, I've seen some content out there in the space, and from my understanding, NAV erosion happens when an ETF pays out more than it actually earns. That chips away at the principal and hurts long-term compounding. So is it that certain high yield products basically hand back your own money and over time NAV declines? Maybe could you just kind of give your viewpoint on maybe what it is and how Curve approaches this differently?
Curve is a fiduciary of our investors' capital, so we really guard against this effect called NAV erosion, and you explained it pretty well. A common example that I use is if you are a landlord, you have an apartment that you rent out, you expect to receive $2,000 a month from rent, right? And then one month, one of your tenants is a little bit late, and you start to sell your kitchen to make up that $2,000 worth of income, right? You're eating into your house, which is not really the best thing to do. NAV erosion is an effect in which when you have over distribution, you have to essentially distribute some principal back in order to meet a particular yield target. And over time, if you do it over and over again, you'll see actually the NAV decreases. And this is especially stark when you say if a strategy is tracking some name and the name is going up, and your investment on a price basis is going down in the opposite direction. So that's a very clear sign of what NAV erosion is. And I think we want to make sure that people get income that they can use, and at the same time have enough principal to generate that income consistently without eroding it.
So, Howard, what's this? I know when people talk about NAV erosion, there's also another term that they often coin. What exactly is return of capital?
Yeah, return of capital in a normal sense is, any capital that you get back that is above and beyond your tax liability, essentially. And so, in a mutual fund, a lot of the reasons why people like ETFs over mutual funds is typically that you get a tax bill in December, because in a mutual fund, which is a 40 Act fund, 1940 Act fund, you have to distribute what you call the net investment income as well as any realized gains within that roughly that calendar period. In an ETF format, and for since the beginning of the ETF, there's abilities to essentially reduce that realized gains. So if you distribute the same amount and there's less net investment income and realized gains, a part of that will be categorized as a return of capital. And that's just sort of a tax designation. And it's advantage because return of capital is not immediately taxed. The distribution goes to decreasing your basis. So you are able to invest that or reinvest that into the fund. So you're able to defer taxes on that income until you sell the securities out of your portfolio. But of course, this is categorization on a high level, and we're not tax advisors. So I would encourage each person to reach out to their tax advisors to see what is applicable, what is not in their investment portfolios.
Since this is our 10th episode of Curve Your Enthusiasm, I kind of want to zoom out for a second and do something a little bit different. Howard, I know you spent some time at Goldman Sachs as a asset allocator, and both you and Dom spent several years over at PIMCO. You could have stayed in those seats forever, right? So why Curve? Why leave all of that behind to build something brand new from scratch?
Dom, why don't you go first?
Yeah, sure. Excitement of the startup. When I started at PIMCO, I was employee number 13.
Oh,
So it's
wow.
kind of the same vibe, in London and not worldwide. So I have to create something from scratch. That's a good challenge. And it's in financial markets.
Yeah, and for me, very much the same way. I do still think Goldman and PIMCO some of the best firms, and you really learn a lot of best practices from risk management, how to look at markets that you really don't get anywhere else, right? And the excitement of building a new business is also pretty exciting. And so how could you merge with like what you have learned in the past and then do something new completely at the same time is actually pretty exciting for me. And we're doing a lot of stuff that PIMCO doesn't do, Goldman doesn't do. We're in new territories using the best practices that we've learned. So that it's merging of both worlds. And I think we don't often mention this, but there is a reason why we're called Curve. We're called Curve because it's an acknowledgement of our past and where we want to go in the future. PIMCO is still one of the best firms to manage fixed income. Curve does refer to the yield curve as a nod to the past. And then what Curve does is when you want to invest, you have to invest ahead of the curve. And that's what we hope to do in all of our strategies.
Wow, that's powerful. And I think that vision, taking institutional grade tools and strategies and putting them in the hands of advisors and everyday investors through ETFs, it's exactly what makes Curve different. So thank you both for sharing that. I mean, I didn't know some of the stuff. So awesome. All right. Well, this has been such a great conversation and a huge milestone for us. We've hit gold and silver at new highs, crypto's rally during a shutdown. We talked about the Q4 outlook, the Fed's impact on income, NAV erosion, and of course, the story of why Curve exists. So, Howard, Dom, thank you as always for your insights. And to our listeners, thank you for tuning into episode 10 of Curve Your Enthusiasm. If you enjoyed today's discussion, please subscribe, share it with a colleague, and visit curveinvest.com for more resources. Until next time, stay curious, stay diversified, and keep your enthusiasm high.